next question to be reviewed is par. And here is the background information. You can read it first and then coming back. Par company currently has the following long-term capital structure. So the balance sheet, some of the items in the balance sheet are shown here. And the explanations of the balance sheet items here, you can see the 8% loan notes are convertible into 8 ordinary shares per loan note in 7 years' time. So in other words, the convertible loan notes can convert 8 shares, ordinary shares, in 7 years' time. If not converted, the loan notes can be redeemed on the same future date at their nominal value of $100. And the company par has a cost of debt of 9% per year. The ordinary shares of par company has a nominal value of $1 per share. The current ex-dividend share price of the company is $10.90 per share. And share prices are expected to grow 6% per annum for the foreseeable future. The equity beta for this company is 1.2. The first requirement is asking you about the loan notes. The loan notes are secured on non-current assets of Par Company Limited, and the bank loan is secured by a floating charge on the current assets of the company. So the loan note is a fixed charge. On the non-current asset, and the bank loan is secured by a floating charge on the current assets. And the question is, which of the following shows the sources of finance of Par Company in order of the risk to the investor with the riskiest first? So in other words, if the higher risk here on the left-hand side, and on the right-hand side should be lowest risk. Okay, so we can check. If it is the riskiest, in other words, when the company is going into liquidation, the creditor hierarchy is the key point. Okay, the riskiest should be when the company is liquidated. They have the claims, they have the lowest priority to claim any financial benefits from liquidation. So the lowest priority in the claims, the first one should be the ordinary shareholder. Okay, they have the lowest priority to claim the company when the company goes into liquidation. And next is the preference shares, the preference shareholder. In general, preference shareholders have no charge on any assets of the company. And then will be a floating charge creditor, because even they have the charge on the asset, however, they have not fixed on a particular asset. And the safest creditors is those with fixed charge. So 1, 2, 3, 4 here, you can see which answer is correct. Should be D. The ordinary shares is the riskiest item. They have no claims or they have the lowest priority to claim when the company is going into liquidation. And next should be the preference shareholders or the redeemable shareholders here. And then is the bank loan because they are secured by the floating charge of current assets. And the last, the safest type of investor is the loan notes holder. The second requirement here in this question is, what is the conversion value of 8% loan notes of power company after 7 years? To determine whether the loan notes will be converted into ordinary shares, we have to make some assumptions. What is the share price assumption? Okay, what is the share price after 7 years? It is assumed that the share price will grow at 6% per year. And the current share price is $10.90 per share. So $10.90 times annual growth rate is 6% with 7 years. So the exponential function is 7 times. Then you got $16.39 per share, and $100 or the one loan note can convert into 8 shares. So the total value will be $16.39 times 8. You got $131.12, which is per loan note value, which is higher than the redeemable value at $100, right? Here it says that the loan notes can be redeemed on the same future date. If, for example, they don't convert into ordinary shares, then they can redeem it on the same future date at the nominal value of $100. So here is the conversion will give a higher value as compared to the redemption of the loan notes. So in other words, okay, here is the answer C. In other words, the investors, if it is true, they will convert into shares because they can maximize their wealth. Next, the third requirement here is asking you that the conversion value of the loan notes after 7 years' time is $126.15. What is the current market value of 8% loan notes of power company? And it is a question asking you about the valuation of the loan notes, and the cost of that given here is 9%, right? 9%. And we have the terminal value at $126.15, and you know that it is 8% loan note. So on an annual basis, you will receive $8 interest for 7 years. So the discount factor or discount rate applied is 9%, which is given in the question. And the annuity factor for the interest for 7 years will be 9% is given 5.033 times $8. And the other is the discount factor with 9% and 7 years time. For $126.15 per conversion value. And if you check the formula sheets given, the discount rate is at 9%. You will have 0.547. So you can use your calculator to get the annuity factor of interest is 40.26, and for the conversion value with discount factor at 9%, you got $69. So total should be $109.26. So the answer is B. Okay, so in this question, you have to know how to get the loan valuation given the cost of debt to you, and with some very basic concepts. For the fourth requirement, which of the following statements relating to the capital asset pricing model is correct? Okay, it's a good example here because the question designed is mainly for business valuation. However, in some occasions, in some cases, the examiner would like to test you with some related topic, but in other sections or in other areas. Like here, we are asked about the capital asset pricing model for it, but it is relevant to the valuation. Okay, it is relevant to the valuation because we can adopt the cost of equity, and the derive of the cost of equity is from the capital asset pricing model. So let's check here which statement is correct. First, the equity beta of power company considers only business risk. For equity beta, it considers both business risk and financial risk. So it's wrong. For B, the capital asset pricing model considers systematic risk and unsystematic risk. Remember the formula here for the capital asset pricing model. If you check your formula sheet, it is the risk-free rate plus the beta of the company times the market risk premium. Okay? And for this beta is the risk measurement. However, it is only consider systematic risk. It doesn't consider any unsystematic risk. So B is also wrong. For C, the equity beta of power company indicates that the company is more risky than the market as a whole. So what's the market as a whole risk? Okay. In our lecture talking about the capital asset pricing model, we talk about the security market line, in which it means that the market portfolio is held, and all the lines on the security market line should truly reflect the trade-off between the risk and return is justified. And normally, the market portfolio, the beta is 1. And here, the beta is 1.2. In other words, the company beta shows that it is more risky than the market. So the statement here is correct. C, the debt beta of power company is 0. Okay, in the question, it doesn't mention about the debt beta, and we cannot just assume that it is 0. So it's not correct. So C is the correct answer. For the fifth requirement, it is also a question asking you about the statements. So there's 4 statements in which you have to choose which one or all of them are correct. It says that which of the following statements are probably using the price-earnings ratio method to value a company. So it means the problem. The first is that it is the reciprocal of the earnings yield. It's true that price-earning ratio is the reciprocal of earnings yields because earnings yields means the earnings divided by price. So in general, it's correct, but it's a problem in using this. It's a problem. The first statement is only a description, and it doesn't create any problem, so it's not correct. The second one, it combines stock market information and corporate information. Is the PE ratio contain any market or corporate information? It is not true. It is not true. Because the PE ratio is the PE ratio for divided into the industry PE ratio or a specific company PE ratio. For a specific company PE ratio, it is not exactly the same here because the PE ratio mainly reflects the corporate information, but not the stock market information. Okay. For the third one, it is difficult to select a suitable price-earning ratio. Yes, because of the size, the business exactly, and operation may be different between 2 companies. So it is very difficult to select a suitable PE ratio for the valuation. The fourth one is the ratio is more suited to valuing the shares of listed companies. Yes, it's true because PE ratio is concerned about the earnings. Okay, it's concerned about the earnings. With a listed company, a lot of listed companies shows the earnings to the investors. So it's more suited to valuing the shares of a listed company. For a private company, maybe the DGM, dividend growth model, is more relevant if the company is already operating and for many years, and it's much more better for us to use the DGM for those private companies with long history. And here, because 3 and 4 is correct, so the answer is B.